Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes here on Options Guide TV. Today's date is Monday, May 20th. It's NVIDIA's earnings week, so I don't care about what other economic news is out there. The big event is going to be Wednesday after the close. NVIDIA's earnings has probably been the most talked about company that hasn't announced earnings yet this earnings season. So everybody's waiting at the edge of their seat to hear what they have to say in their conference call after their earnings report. And it's very questionable that if they do blow the numbers out, which they've done the last couple of earnings, how big do they need to blow them out in order to keep this stock on its bullish trends? So today we're going to look at our trade. We talked about it on Wednesday. We did a trade that didn't have a lot of risk, but the probability of a huge move to the upside was limited. And that was an inverse skip strike butterfly. We will look at that here in just a second inside the options playbook. But what that trade was basically an alternative to, you need a type of movement that you'd be looking for in a long straddle, in that you want the market to go in either direction, and you want it to go fairly heavily in that direction. And implied volatility helps you out a lot on that trade. So in other words, if you are incorrect on your forecast, but implied volatility increases, it can save you. And so I wanted to bring it up today because NVIDIA did exactly what we didn't want it to do, and implied volatility saved us. And so it is a lesson about a trade that didn't pan out, but the fact that you set up the trade correctly absolutely protected you and your margin requirement that you had to put into the trade. Okay, so let's start by talking about that trade. And in a second here, we're going to run over and look at the playbook. But we're also going to look at a new trade in the S&P 500 index. This week, we're going to do a skip strike butterfly. And then on Wednesday, we're going to come back and we have our big event here for Tradier and the Chicago Board Option Exchange, otherwise known as Cboe Global Markets. That's their new name. I don't like it. I want to go back to the Chicago Board Options Exchange, but I am old school and I don't really have much say in the naming of that exchange. But with that said, on Wednesday, it's going to be a big event. It's going to be huge. A lot of the speakers from options inside the Tradier Hub are going to come together with speakers of the Chicago Board Option Exchange and other speakers within the industry and have an all-day event. So we're going to actually tape Options Guide TV on Wednesday, and I'm going to take the paper trade, the deep in the money call option that, I'll be blunt, we knocked it out of the park. Now there are some in there that we haven't, because I always feel the fair and balanced thing that we didn't do as well as in NVIDIA. But NVIDIA by itself, we bought it in November. We bought it we bought it right at the moment that NVIDIA really started to take off. It's been taking off for a while, but it really started to fly most recently in November. And we ended up rolling that position up. So I'm going to come back on Monday and I'm going to show all the math that's behind the trades that we did, and actually look at where that position is at inside that portfolio. So I'm going to put together a PowerPoint on that, and we're going to tape it, so it's not going to be a live event. So on the big day, the big event, we won't be live with Options Guide TV, but we will have a very pertinent show relative to the big event based on NVIDIA. All right, so let's go to the options playbook now. Let's zoom in, and this is the skip strike butterfly with calls. We also looked at, and I didn't go back and grab the numbers. This was the official paper trade, but we did have a question on the show, and we just talked about a ratio, a back spread. It would be a better word. That's the strategy that we have in the playbook, and I'll pull up another options tab over here, and we will look at that back spread. So the back spread just doesn't sell the additional call, and it takes a lot more gumption to do it, mainly because you have what do you have? You have a much larger requirement to put on because of that. So here's the back spread. The back spread, we don't sell this call. That means we got to go wider out because we don't have the credit to help pay for this. So the distance between strike A and strike B is wider. That means you have more potential loss. That also means you have a larger margin requirement. The trade that we did make, the official paper trade, we did it a couple of weeks ago in NVIDIA, and that was the skip strike. By selling this, it helps pay for these two calls in the middle, and that means that you don't have to go as wide to make it a feasible trade where you can get it done for a net credit to the account. So now let's zoom back out for a second. We're going to look at this trade. So let me run over to the TradeHawk software. And now we're up and running. Let's run to the TradeHawk software then. So here's where NVIDIA is. And this is why I wanted to bring up the trade today, because this really is a perfect scenario in that we did this trade a couple of weeks ago. The implied volatility, well, I can tell you exactly, it was 16 days ago, because I do have the screenshot of when we did the trade. So 16 days ago, implied volatility was at 72%. We came in and we bought, the stock was right at 900. We sold the most at the money option contract, which was the 900 strike call. And you're going to see that down here in the order ticket. We then went out 50 points. That means that we are 50 points wide on our requirement for this trade. And we bought two of the 950s. So we sold this option contract and brought in enough capital to come close to paying for two out of the money option contracts. And then we went out and we sold, we skipped a strike, which would have been well, we didn't quite skip the exact strike, but we skipped the 1,000 strike, if you want to look at it that way, which would have been right here. And we sold the 1,025. We brought in a net credit to the account of $1.67. So if we flip the script right now, we would be paying a net debit. So this is where the trade would be at. If we went in, we would buy to close, we would sell to close this one, and we would buy to close that one. And we'd pay $1.47 for that trade. We would be up 20 cents on a trade. And guess what NVIDIA has done? It went exactly, it basically flailed around and didn't do much. And in the last few days, at the end of last week and this week, it finally started to make some moves. And we had a move up, and then it came back, and now it's sitting right at the precipice, right at the bottom of that channel that we had when we looked at the options playbook, like the worst place possible for it to hang. But implied volatility right now is at 104. So guess what? We were incorrect in the forecast, and that we needed more than we needed about a 4% move. And if it went down, the maximum we could make was $1.67. We could have made the net credit. But we needed this stock to move 50 points to do it in a points fashion in one direction right away. We needed the big move right away. And if it went 75 points, that's still not a huge percentage move. So 75 divided by 900, that's about an 8% move, which NVIDIA has done that time and time again without the earnings report. So this is going into earnings. We were looking for about that type of move, and we just didn't get it. But implied volatility saved us. Implied volatility went from 70% up to 103. So I'm going to send this to the what if calculator. And shoot, I got to flip the script. Here we go. So that's what would be the close, the net debit, right? So now we're going to go in and we're going to sell to open. We're going to buy to open. We're going to sell to open. All right. So now we're back to the original trade. It's now a $2 credit. So the market is hurting 101 in the vol. All right, let's send it to the what if calculator. All right, so this is as of today. Remember, we're not back testing this or doing anything fancy with it. What we're saying is this is what the implied volatility, what the graph looks like on a normal basis is this line. If it goes all the way down, it's got to go down quite a bit before it really starts morphing in towards the expiration graph. And then on this one here, it's just kind of hanging out right at this precipice, right at the worst possible spot that it could hang out, which is 50 points higher than when we put it on. We needed it to get up in this range is what we were looking to do, but we knew implied volatility could save us, and it has. And so at worst, I would try to get out, or we'd be out at break even. We looked at it on Friday's show, and I think we could have made 20 cents on Friday's show, and that's what we decided to do. I didn't want to be in it to this week. The goal was always to be out of it before the week got here. We did a 16-day trade. We got out on the Friday officially as far as the paper trade is concerned. And this is where the market is at. But it did prove itself in that we did get enough of an implied volatility increase going into earnings to save us on this trade. And if we did get that fairly black swan event, I guess, for lack of a better way of saying it, where we got an 8% move in either direction over that 16-day period, then we're golden. So very little risk because we set up the trade right. We bought we put this trade on with an expiration that contained the earnings that expired after that earnings report, and inferring that implied volatility would increase. It did. It increased enough. The stock went to the exact wrong spot, and we still were okay on the trade. So it was a good scenario to be able to do this in NVIDIA, the biggest talked about stock right now. So just want to keep that in mind. Just wanted to bring that up and say it's not a trade that you're going to want to do over and over again. I wouldn't mind doing it in NVIDIA next time around. So we'll probably set it up here on Options Guide TV going into their next quarterly earnings, depending on what's going on in the market. All right. So we're going to go back. That was a little long-winded. If you have any questions and you are in the YouTube platform, you can ask those questions. All right. I see Wayne's already in here. So before I transition to the SPX, let's go ahead and address that question. All right, Wayne. Hey, Brian, the VIX is almost at the lowest it's been for years. Does that mean these are much less puts that have been purchased for protection? Yes. Okay. So the VIX, the volatility index, is trading down right now. I think it's around 12%. Yeah, 12.27 is where the VIX is at. And that's the lowest it's been for quite some time. And it makes sense. We just set an all-time high in the S&P 500 index. And so when you set an all-time high, or when the markets are going up, usually the VIX has a tendency to go down. And that's just because people are feeling more comfortable about their situation in their portfolio. So what really drives the VIX is people buying out of the money puts as protection. And if you ever look in the SPX, which the VIX is calculated on, you always see a lot more open interest on the put side of things than on the call side of things. And that is just a function of the fact that there are so many funds that track the S&P 500 index and trade those stocks that are in it to try to match or do better than the performance of the S&P 500 index, that a lot of people use that index as protection. So when they're nervous about the market, they're willing to pay up for protection. They're willing to pay more for that put to ensure their portfolio. So with the VIX at these levels, yeah, that does imply that the implied volatility, that the demand for out of the money puts or just puts in general is lower in the VIX than it has been in a long time. And it shows some complacency in the marketplace. And that has a tendency to happen when the markets are at all-time highs. Thank you for your question, Wayne. All right. If I look at my trade, we have this 190. It's jumping all over the place. Let's look at the SPX now. Okay. So I went back and forth on the trade today. I still think we're a little bit overdone in the SPX. 53.20 is where we're at. So we did give up a little bit of gains, but we're still got a strong move today, a third of a percent, up 17 points. VIX is actually down 30 cents. Oh, actually, the VIX look at that. The VIX is up 30 cents on the day. So showing a little bit of nervousness. I wonder if that's because of the Nvidia's earnings this week. Just maybe that event itself is driving the VIX a little bit higher, but who knows exactly? That would just be a off the cuff guess. So we're going to still look at the SPX. Now, I would rather trade in the SPX with the VIX higher. I like it around 15%. That just gives you more juice, more options to adjust your trade. You get into the trades for cheaper. Butterflies are cheaper to start. All these things, right? So I kind of like that range, but it's not going to make me stop trading because the VIX came down to the 17 level, or to the 12 level. 53.20 is where we're at. We're going to look at this Friday's expiration date. So in that instance, we're talking about May 24th, which is 4 trading days away. And we're going to look at a 1 standard deviation move where the delta will be close to around 16 in that scenario. So May 24th, it didn't click. There we go. That looks a little better. I knew that was too close for a 1 standard deviation move. And our implied vol, okay, so 53.90. So once again, in the TradeHawk software, we have the calls on this side and the puts on this side, like almost every trading platform that has an options grid or options quotes. And what is nice about this software is that you can highlight where a 1 standard deviation move is. A lot of platforms will highlight in and out of the money option contracts. The TradeHawk software highlights the most at the money option contract and then allows you to decide where you want your shading. And I really like having it right around the 1 standard deviation move. And you can always confirm it by looking at the delta. The delta should be fairly close to 16 in that event. So I'm going to look at a 15-point wide trade today. We're going to go a little bit wider. Might be a little bit harder to get it done for a better net credit to the account, but let's try it. Let's look at it. 53.90, we're buying that one. We're going to go to the 54.05. We're going to sell 2 of these. So that's means 30 points now because we're going to skip that 1 strike. And we're going to go at the 54.35. Okay, and buy that one. We're really close. So we're at a 0 midpoint for this. I'd like to get a little bit of a credit. And this is always a tough one. I want to be farther away from this strike to this strike. So let me explain what I just said. From 53.90 to 54.05, you want this option contract to do a lot of work for you, is what your goal is. And you want this option contract to wither away. So the difference between those, the 53.90 and the 54.05, the wider they are apart, that means, well, this one's going to get hurt faster, right? Because you're so far out of the money. And this one is actually going to get rewarded faster. So if the market comes up to 53.80, this one can still wither away because it's still way out of the money option. And, well, a decent amount out of the money option. And this contract will still hold a lot of premium because it's so much closer to where the actual index is at. So in that instance, I prefer to do this. And sometimes you can get them done, but I think what's really hurting us here is the fact that the VIX is down at this level, at the 1230 level. So we're going to have to go 10 points wide. Once again, not that I say that like I'm very sad about it, but we've done this before. And I've done it before in my own personal account. 53.90. We're going to then sell the 5400. I like that it's right around that 5400 level. It's a nice big round number. Then we skip the 5410 and we buy the 5420. Now we're getting it done for a net credit of 40 cents to the account. And that's where I'm going to put it in. We're going to call it 40 cents. And so if the market goes down or stays flat, we can make that 40 cents. If the market comes up, we got the potential to make somewhere close to $1,000, and we'll send that into the what if calculator. And this will be our official paper trade for the week in the SPX. And let's pull this down and let's zoom in. All right. So to start with, if you put this trade on, this green line is what is your nemesis, right? This is it hurts when you first put on the trade, and that if the market goes towards our short strike of our skip strike butterfly, it's going to hurt. So you need time decay to happen. And so this is as of this date. Then we go to Tuesday, it starts moving up a little bit. And this is in theory, just using the what if calculator. Now we're on Wednesday. Now we get to Thursday. Now we're not that bad in this range. And then we get to Friday at 11 o'clock, and now we're good. So if we're doing this trade, we don't want to get anywhere near this until the end of the trading day on Thursday. If it goes down, we can still make 40 cents on our $1,000 requirement. So 40 bucks on our $1,000 that we put up. If we land somewhere in here, we could make as much as 10 points at expiration. If we move this date closer to the expiration date, let's go in and say 1322. Let's go 1422. Now, as we get closer and closer, this expiration, this curve, and this is a little bit right angle-ish. It should be a little bit more curved. But in that range, we're going to land somewhere right around here. And if you see this, this would be up around $400 on that trade. Our maximum risk is $1,000. And that does not kick in until we get to our short spread, which is from 54.10 to 54.20, which is that strike. And that's where our real risk is. That's way more than a one standard deviation move. As a matter of fact, let's look at that. Where is this one? Okay, so that's a 9% chance. That's where the delta is at. 9% probability of that stock finishing 1 cent in the money or more at the expiration date of this option contract. All right, so let's put it in the books. This is the official paper trade for this week. We're going to use the Friday expiration, May 24th. We're going to be buying one of the 53.90 strike call options, selling two of the 5400 strike call options, and then buying one of the 5420 strike call options. Limit of 40 cent net credit to the account. It looks like it's trading close to 45. We're going to keep it right at 40. Let's just do that for the screenshot because that's where it was when we first looked at it. And now with NVIDIA coming up, I don't, if you're trading NVIDIA and you have shares in your account, one thing that you might think about doing, and we've done this with Apple because there's a boatload of, Apple is probably one of the most widely held stocks at any brokerage firm, and it was at our brokerage firm throughout the life of my brokerage firm, which was Trade King, that eventually got bought out by Ally Invest. One of the things you want to think about if you want to buy some protection is to actually buy the put spread as opposed to just buying puts outright. So if I'm thinking about it, and I do actually own 100 shares of stock, even 100 shares, if you have 100 shares, well, first of all, congratulations, because odds are very high that you've done well with it. And all of a sudden my computer stopped. Okay, NVDA. I'm kind of freezing up a little bit. We're almost to, okay, there we go. NVDA. So if I'm buying this option, I don't want to go that far out in time. I don't want to spend a lot because the only thing that's going to make me nervous in NVIDIA is what might happen after earnings. They could even blow earnings away and the stock could still go down. It's done that before. So if you did want to hedge your 100 shares of stock, and you don't even need to have 100 shares because you can trade this if you would like, but you can buy a put in it. And I would look at probably a 10-point wide put. I'd buy somewhere right around the 935. I would do this closest. I would do it on the earnings day. I would do it on a Wednesday. And you look at buying this one and giving yourself maybe 15 points and we're going to sell this one. And you're looking at spending $7 to put that trade on, as opposed to just buying that put outright, which would be about $30. We're going out 11 days. I'm not going to use the same expiration, which is only 4 days away, but I guess you could. I'd be okay with it if you just did it for 2 days. I want a little bit longer protection. I'm going to do the 11-day option contract, pay about $7. It's going to give you from $9.35 down to $9.20. And you got the maximum that it can make is about $15. Quick, dirty, fast, one way to protect yourself if you're thinking about it. Also doing the inverse skip strike on the other way, on the other direction. And it's also known as a pay later put sometimes, where we did it on the call side, use the put side. The only thing is that implied volatility is scary. And where it benefited us going in on the call situation, it would be a little bit more nerve-wracking on the put side after earnings. All right. No further questions. Thank you for coming. This Wednesday, I will have an education piece based off of the deep in the money call options that we bought in our paper trading portfolio, just running the numbers basically. And please tune in to the CBOE event with Tradier on Wednesday. So hope to see you soon on Options Guy TV. Next time we'll be live is this Friday at 11 a.m. Thanks for stopping by.
Calling all options and futures traders. The markets may be wild, but you don't have to be. Join the Tradier Options Summit sponsored by CBOE on May 22nd. Let's tame the volatility with expert tips and strategies on navigating volatile markets in 2024. I will be hosting this full-day virtual online event. Learn from the best. Industry leaders will share their insights, trade ideas, and strategies on navigating these volatile times. Plus, get a sneak peek into Tradier Futures, which will be launching soon. Sign up now to be part of the action. Reserve your free spot by registering at the link below. If you're a part of our email list, stay tuned for your invitation and link to register. See you on the 22nd at 10 a.m. Eastern Time, sharp.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved. Member FINRA SIPC.